Okay, so that's an echo. Okay, so I'm going to do the best I can to do just like a basic income tax review for um, for you all. I mean, so the purpose of this review is not to tell you everything that's on the final. The purpose is to give you a general outline of like highlighting just some certain topic areas so that it can help you through. If you have specific questions, you can ask them. I'll do my best to answer them. Um, if I don't cover something and you have questions as you're doing your studying, you're welcome to email me your questions, and like I told you in class, I'll just respond most of the time through Blackboard. If you don't get a response, two things. One, I may not have a response because it may just be something that you just have to look up, or I may be getting a series of questions that are similar, and I'm just kind of combining them together and going to answer them all at the same time. So just don't, like, if I don't respond to you right away, don't freak out. Just kind of move on, and I'll get back to you. Okay. So the the class really began, and the last thing is, if I don't cover it here, it also doesn't mean that it might not be on the test, right? So just because like I skip something or I'm covering just general stuff, that doesn't mean it's, if I covered it in class, it could be on the test. If it's not covered here, that's not exclusive one way or another. I guess I have to do all these disclaimers since it's being recorded as opposed to.
We have access to our computer or is it shut down?
No, I think when I last time I talked to Jim, it was you can bring in anything you want, but because it's using ExamSoft and it's closed, you won't be able to access the internet or like your outlines on your computer. So you have to come and have printed your. I'm gonna post that on Blackboard though, so everybody can see it. So you can bring in anything you want as long as you prepared it. You can't bring in like a manuals. You can't bring in like blacks or something like that. But you can anything you prepare. Now, if you want to type a manuals into your outline, go for it. Like I don't care. Like you'll probably learn it that way too. But if anything you prepared or you prepared with your group, you can bring in anything that was assigned in the class. You can bring in. So you can bring in all the slides. Anything you want to bring in, you're welcome to bring in to the class. What?
Should we bring in the textbook?
Yeah, just you probably won't finish if you're like looking at all the stuff. That's my only thing. You can't bring in an accountant. You can't bring in a lawyer. Can't bring in another law professor. Other than that, you're like okay. Um, Accountants probably would bomb this test because there's no room for vagrancy with an accountant.
I'm guessing we'll need a basic calculator or do you want me?
To the extent there is math, I try to keep it simple so you could do it in like quickly, right? I'm not trying to make math overly complicated, and I don't expect you. But if you have a hard time with like basic addition subtraction, you can bring a calculator in. But I mean it's basic, and but you can whatever if you want to bring it in because you're worried about it, that's fine. So the class started off like the way I tried to describe the class, and I think it's a hard class to describe because as you can see now, we've covered so much stuff in so many different areas. I try to cover it in kind of four basic ideas. Like I've tried to define it in four ways. Like what's income, when is it income, what's a deduction, and when is it a deduction, right? And if you think about it, those are kind of the questions we answer throughout this class, which is let's figure out what things are income. Then we went on to when is it income, right? The constructive receipt, economic benefit test, all those kind of tests. And then we moved on to deductions. We kind of defined what deductions were. And then we ended class talking about like when is the right time to take the deduction, right? That was the business, especially when we were in the business world of deductions, whether it's currently deductible or is deductible in the future or which track we took. And I think if you kind of compartmentalize it that way, hopefully we can then categorize everything within one of those big pillars, and it can help you if you're struggling, but also helps you maybe make sense of a class that probably doesn't have much sense to it because it's so many different little subtopics within those bigger topics. So what is income? Everything's income, right? So the key thing to remember when you do with what is income is you start with the premise under section 61 that everything's income unless you can give me a specific exception to the rule, right? So the rule is that it all is income. And then unless you can tell me it fits within a category specifically, if it doesn't, then it's income. Our default, right? A lot of tax ends up being, after we explored everything, going back to knowing what your default is. So the default is everything's income. Now, we know certain things aren't income because they're defined out of the default, right? So the first big category we covered, the book calls non-cash benefits. So when you deal with meals and lodging, those things seem like they should be income, but Section 119 carves out from that definition, if you meet the requirements of 119, that they're not income. And so we talked about like the Benglia case. We brought that up a lot this semester. But 119 really says, you have to meet those key requirements. And we spent some time in class going over those requirements to show how you have to meet all the requirements, not just some of them, to move outside the statutory rule. So it had to be for the convenience of the employer. We talked about what that meant. We talked about what furnished meant, right? You couldn't just give someone cash to buy the meal like the fireman cases. You had to give them the actual meal. You convenience an employer, you had to be on call 24 hours. It had to be on the business premises. We kind of talked about what that meant. You had to be an employee, right? So if you failed any of those tests, the consequence was our default is income. Here was a potential exception. You fail part of the exception, you move back to the default, right? And that's why like basic tax ends up being a really good statutory class, because it teaches you how to read statutes. So as long as you understand that premise with tax, you'll do well. Know what your default is, and then know if you're in the exception. And if you fail the exception, you move back to the default, right? We're going to talk about that shortly when I get to divorce, right? And alimony, we have a default if it's income. If you meet the definition of alimony, right, you've moved out of the income default to we're reallocating it amongst the people, or non-income default, right? Because it's a property settlement. So whatever you have learned as the default, that's the key part with income tax. So we talked about then some other types of non-cash benefits from 119. We went to 132, right? In section 132 were the various other types of things that your employer provides for you that should be income, but we carve out because of 132. So we talked about like the no additional cost services, the free seating on the airline. And so, right, is it a free seat? Well, maybe. It's not income to you as long as you don't bump someone off the plane. But if you want a hard ticket, then it's not free to you anymore, right? You've required the employer lose money, and since the employer has to be required to lose money, it becomes income to you. That symmetry of the sacrifice, guaranteed sacrifice by the employer. You see that also with qualified employee discounts, right? So qualified employee discounts, it's fine to give the employees a discount, but the employer can't lose money. When they cross the threshold of losing money, it bumps that from being a free exception to being now income to the employee, right? So we talked about that. We talked about de minimis. One of the key things you have to remember in section 132 is it has to be in the same line of business. And that's important because a lot of bigger businesses have multiple business lines that are all housed within the same business. And so if you're Brown-Forman and you work for the liquor part of Brown-Forman, but you're getting a discount on the luggage that they sell, that's not the same line of business, right? That's you work for the same company, but you have to be within the same business line to get the business discount. Then we moved on from those kind of one. So we have the two big exceptions to Section 61 income from your employer are 119 and 132. And then we moved on to talk about health insurance, which is 106. And so health insurance is not income to the employer. I mean, an employee, but it's also it's actually great because it's deductible to the employer. It was probably premature to have to talk about deductions then, but as we can see now that we've covered deductions, that's a really good benefit. It's very asymmetrical, right? You have no income to one party and you also have a deduction to the other party. That's one of the rare instances in the code that you have that asymmetry. And you could see it's for one of the most important things is we have to subsidize health insurance some way, and that was the way they decided to subsidize health insurance. So that was the frame for what's income. Pretty expansive what's going to be income unless we hit these carve outs. But even if you lose on the carve outs, the second step is when I think about income is this income or is this one of the exceptions? If it's not one of the exceptions to income, it's income. The question then goes to the next, which is really, as we saw, one of the most important questions, which is if it's income, how much is it income, right? The valuation question of what you receive. And that really reared its head at the beginning case of determining income with Banglia, right? There was lots of different ways we could value the hotel. If it was income to Banglia, the hotel room, it wasn't, but if it was, as we saw in the dissent and we saw in the way that the majority addressed the decision, there's lots of ways we could think about how much income should have been included in Banglia's account, right? Was it the value of the room and the fair market value? Is it like a discounted value? Is it the value of the maid service? And this comes up in a lot of different circumstances, right? We saw it in Turner with the cruise ship tickets. The taxpayer valued them at $520. The IRS argued that they were worth $2,200, which was the market value. The court split the difference, but the real test is it's that subjective taxpayer value should be the test. The problem is if you value stuff at nothing, we don't really believe your subjective value. So we try to look for objective criteria to try to determine what your subjective value is, right? It's a really weird way to go about it. But we try to use objective criteria to set like a cluster of data points on what this could be. And if you're within that cluster, the court's probably going to agree with your subjective value. If you're outside of that cluster, you're going to have to justify why you're so far as an outlier as a lower number. Otherwise, the court's going to end up probably back somewhere in that cluster of data points, right? So all those things you could think of how we value everything, that's your cluster. And the further you are from that, the more justification you have to have. And that's what you see in all these cases. You see it in Turner. You see it in McCoy. You saw it in Rooney. And then we talked about it a lot in the idea with the home run ball, like with Barry Bonds, right? We use that as a good example for how that one ball has lots of different values to lots of different people. And values change over time. And what we just try to do is to try to determine valuation, we have to come up with the best. Like if you're the court, right, if you're arguing for the taxpayer, you're just going to justify the taxpayer's position at the low number. If you're arguing for the IRS, you're going to try to justify the highest number. But if you're the court, you're going to have to try to figure out which is the most accurate representation of what that taxpayer's subjective value is. And we talked about it a lot in context of like trying to sum up with using the home run baseballs as the example. And so even when you're done with determining that, the second order events, then we talked about even with the home run baseball, how that affects what goes on. We talked about once the team took the baseball and then they gave it to Bonds, then we had to now make another analysis was when the team gave it to Bonds, was that income to Bonds? Was it a gift to Bonds? And now you actually have a more robust understanding if you went back and thought about that example, now that you know Duberstein and employer gifts and what's the requirement of that, whether or not if the team gave the ball to Bonds, for example, what would be the result? Should it be income? Does it fall? We talked about whether it maybe fell within one of those exceptions to income. But if it doesn't fall within those exceptions, is it a gift? You probably have a more robust understanding now of thinking about, is that a gift of the ball from the team to Bonds? And you can overlay the Duberstein analysis of employer-employee relationship gift. That was Duberstein and Stanton or whatever the subsidiary case was. You could look at and think about that as another way to kind of test the way you understand. Not only was it income or not, but also could then there be a subsequent gift that follows that income. So we then talked about imputed income, which nobody liked to talk about because we don't like to think about imputed income. I mean, it's hard to really test much on it. The biggest thing you have to remember with imputed income is the barter exchange analysis, right? Which is we don't have to get paid in money to have income. You could get paid in chickens. You could get paid in sub sandwiches. I don't know. There's lots of ways people pay. The biggest example to try to remember is, usually people exchange services. And you see this in real life as a lawyer all the time. I mean, I just had someone come to me the other day who doesn't have very much money, and they're a painter, and they have a probate question. They're painting our neighbor's house, they had painted our house, and they have a probate problem with some aunt. And they said to me, I know you need the rest of your house painted. Can I just paint the rest of your house and you'll do the probate? And I'm like, no, don't want to get involved in a probate mess for house painting because you'll be done painting the house and I'll be doing probate for the next 3 years. But that would be a barter exchange of services. And the question is then, do I have income? Do they have income? And the answer is we both have income, right? And then how do we determine the value of each person's income? Is it the value, you can go back and look this up, but the question is it the value of what you give up or the value of what you receive? And if you think about our basic structure is as if they would have sold their painting to pay for my services, right? They would have given me money for my services. I would have had income equal to the value of my services I give. And they would have had income equal, and I would have had to sell my services and get income and pay them. It would have been the value of what their services were, right? You could I'm 99% sure that that's the right result, because you need to just pay for me in cash. So then we talked about, after imputed income, we then talked about windfalls and gifts, which are excluded, right, under 104A. But certain things are and certain things aren't. 104A says, if you have a gift, it's not income. But it is income, for instance, if you have punitive damages. Right? Punitive damages aren't just a straight windfall. That's income to you. Gifts aren't income to you unless there's a quid pro quo, right? And that's what Duberstein talked about. So the question is, if there's quid pro quo, how do we determine that? The Duberstein test is, right, detached and disinterested generosity. Otherwise, if you expect something back in return, you don't have detached and disinterested generosity. You have, I'm paying you for some future service. That's income. It's not a gift, right? You've moved it out of a gift back into income. The test for Stanton now for employee gifts are in 102A. And then we looked at the Harris case in that same context of gifts to try to kind of show the gray area at the end between, there's quid pro quo, but there's family. So the real key is you have to remember gifts have really two different analytical structures. One is for family and one is for strangers / business. Almost every time in the business context you're going to see it's going to not be a gift and be income, because it's very hard to make an argument in the business context. There's no quid pro quo. There's no somebody's going to give me something back for it, right? It was especially hard in Duberstein because the employer took a deduction. They clearly thought that this was a business expense that they were going to get something back in return for. Had they not taken the deduction, it's still going to be hard to prove that they weren't expecting him to do something else in the future that's going to benefit their business. In family context, most of the time you're going to say, yes, there's quid pro quo, but that quid pro quo is love and affection, and that's not what we mean by quid pro quo. And Harris was the strongest extreme of how the courts don't want to get involved with what love and affection is. And you can just think about all the context, just dating, right? Otherwise, every time you take someone on a date and whoever picked up whichever part, there's a quid pro quo. We don't want to discuss what that is in class or especially on a video. But there's an expectation of something, and that something then could turn what should be just a gift into income. And the courts, even though you're not directly family, the courts have defined that as like the non-business setting application of gift, which is you're going to have pretty lenient rules in a non-business application of gift. Most of the time, you're going to have no income, right? Most of the time, it's going to be a gift, just because of the courts don't want to mess around with what the quid pro quo is in non-business setting. And then we talked about the kind of mixed use tips problem, right? So sometimes a tip is expected, right? You're supposed to give, well, it depends how old you are. The older you get, the less you tip. But you're, 15, 20%, something like that. It's kind of what we consider, at least in America, as like an acceptable tip range. Well, if you give 100% tip or more, is that a tip, or is that a tip and a gift? Is it all a gift, right? And that's a non-business setting because you're not the employee-employer relationship. This is the non-business. What should it be? And you could see the courts kind of tend to be all over the place with their analysis on that. And there's a reason, because clearly part of it should be income, the part that's kind of industry standard. The question is, what do we do with the extra part? Courts tend to be all over the place, and sometimes it determines on the industry itself, right? The craps dealers in the casino, they tend to get tipped more heavily. And so we saw that. The restaurant scenarios tend to be more generous because you hear about them anecdotally, but they're not often the case where you'll get huge, exorbitant tip numbers, right? So it just kind of depends on the context. There's always something to keep your eye out for, though, is if it's a non-family but non-business setting. I think I gave the Kobe Bryant example in class that he gave this. What if Kobe had deducted that as like Kobe Enterprises deduction of a gift? Then you kind of, even though it probably might not have been a gift, that's a strong signal that maybe that it was, maybe there was some level of non-gift element if like you look more like Duberstein. So, I always think like Hillary, this comes up right now, right? Hillary Clinton got in trouble at Chipotle for not tipping, right? Even though Chipotle usually is not a huge tipping enterprise, but that just kind of shows that had she left a generous tip because she was worried about, if I don't tip, I'm like Rand Paul was there like a week ago, had he left a double tip that you normally would expect, because so much backlash happened from Hillary, is that really detached and disinterested generosity, or is that income to, like, is there part tip, all tip, or is it part gift, right? And the criteria is not the recipient, right? The criteria is the person giving the gift, right? The test wasn't what Duberstein thought. The test was what Duberstein's employer thought. The state of mind we're concerned with is not the recipient, it's the donor. So we went from tips then to prizes, which are section 117, and that covers scholarships, right? And there's certain, all these things kind of have that same quid pro quo element, right? Which is if you have to perform, if you get a scholarship and you're required to go play sports for the team, it's not optional. Well, that should be income unless section 117 applies, right? The default rule is if you're required to do something in return, that's a quid pro quo, and that makes it income. Right? Most athletic scholarships, most academic scholarships you just have to attend the school, and that's why they're kind of always renewable, because if you don't play sports, they want you out because you're getting a scholarship supposedly to play sports. They can't require you to play the sport, but as soon as you don't play the sport, that's why they tend to be year-to-year scholarships instead of 4-year scholarships, because if they require it, it would be income to you instead of being free. We talked about bequests. Section 102 says bequests are excluded from income. And we talked about gifts in the family context, and gifts in the family context, right, are not income. But we also talked about the added element of if you receive a gift and you don't have income, when you sell what you received as a gift, we had to then determine what your basis in that object was. So if you have income, we know what your basis is. Your basis is equal to what your income was, right? That's the key. We talked about that in all those barter transactions. If you didn't have money to pay me and you gave me the IBM stock, did we both have income? Yes. I had income equal to the value of my services. You had income because you sold. It's as if you had sold the stock and had differential the income between what you sold it for and your basis. That was your income. If you paid for my services I remember we said, let's say I charge you $5,000 for legal fees. You don't have $5,000, but you have IBM stock in your stock account worth $5,000 that you'd paid $100 for. You gave me the IBM stock to pay. If you did that, I had income for $5,000. I charged you $5,000 for my legal fees. You had income because you just, in order to pay for my services, you sold or disposed of your property. So your IBM stock, your amount realized is $5,000. Your adjusted basis is $100. You have a $4,900 income event. And as we talked about at the very end, if it was stock held for longer than a year, it'd be long-term capital gains rates. If it was stock held for less than a year, it'd be short-term capital gains rates, assuming you're just like an individual. Now I have IBM stock. What's my basis in the IBM stock? It's $5,000 because that's what I paid essentially for the IBM stock. It's as if you sold the IBM stock, gave me $5,000, I took $5,000 and I bought the IBM stock. Now, why do I use that example now? Because in a gift situation, I don't have income. If Uncle Bob gives me $5,000 worth of IBM stock that he had paid $100 for, do I have income? Should have income, but I don't because of 102. But now I own IBM stock. How much is my basis in IBM stock? It's the $100 transfer basis from Uncle Bob, right? I don't have income. Because I don't have income, it's not as if Bob sold the stock and gave it to me and I rebought the stock. I just take Uncle Bob's transfer basis. And that was the Taft case, right? Mrs. Taft was arguing that's the wrong application. Uncle Bob had some of that realization, essentially, and he should have paid the tax on that, but that's not the way it works. So you get the transfer basis. And in the gift situation, it's the donor's transfer basis. In the estate situation, it's the estate's basis. And often the estate is going to have a much higher basis. It's going to have that stepped up basis. But that's really for a separate class, the estate side. But the income tax side for the gifts is certainly testable. There's also income we touched on for if there's a below market. Anything below market you have to be aware of, whether it's an OID potential problem in a commercial setting or it's an income tax situation in a family setting. If you see something that says an AFR rate, which will be on the instructions, I tell you what the assumed AFR rates are on the front page of the instructions. If anytime you see interest rates below that stated AFR rate, you have to be well aware that that's a potential income tax event. Because the difference between the stated interest, if it's lower than that, and the AFR rate is either income because it's like a gift situation in a family, or it's an OID problem because you're getting a discounted interest rate. Anytime you see below market interest, you have to be concerned. And the way we define below market interest for tax purposes is the AFR rate is the IRS's assumed adequate stated interest rate. So anytime you see something below that, if it's a family situation, it's going to be potential income. If it's a non-family situation, it's potential OID. So once we finished that, we kind of said, okay, I kind of get that part of income. Now we have to move on a little bit to saying, well, that's for when I earn money. I can also make money because I took the money I made and I buy things. And when I pay for those things I buy, that's basis. And that's when we talked about recovery of capital. So once I take my money and I take the money I earned that I paid tax on as income, right, from my labor, and then I take my labor money and I turn it into money that I'm going to invest to make me money through the money's earning me money, we have to address that through recovery of capital. And we talked about that in the Inja land case, for instance, which is, right, I bought this land, now I'm selling part of that land. We know our formula, amount realized less adjusted basis equals gain realized. Which part of basis do I use on the land? And Inja land taught us there's lots of ways to think about that. It could be you get all your basis back first, you can get all your basis back last, or you can prorate your basis, right? Inja land said there's actually 3 different ways we could think about that simple problem of what my basis is if I sell less than all. The most common application is going to be allocate your basis proportionate to the stuff you get, because the most common application is stocks and bonds. I buy $100 worth of, I buy 100 shares of stock that I pay $100 for. Each share of stock I have a $1 basis in, right? Just divide it. That's the most common application. To move off of that application to say you want basis first or basis last is when you have to show that it's you're unable to allocate basis for some reason, right? Inja land said we were unable to allocate basis, and because we're unable to allocate basis, it wasn't accurate enough, and then we ended up in the situation with Inja land that you had to they took basis first. So if it's, and we talked about that like in the context of like the Oakland Raiders case, when they got those damages, they couldn't allocate basis to the team, so you get basis first. That's a harder argument, right? That's a more rare argument to say. Like we talked about the fallacy potentially in Inja land of making that argument because, right, theoretically you could get an appraiser to say the differential between now and after, and you could probably allocate basis. It's not perfect, but there are arguments to counter Inja land. It's not as clean cut as the case makes it sound, that you're unable to allocate basis. We talked about recovery of capital in context of life insurance. And 101A life insurance, both the proceeds are excludable. A more interesting way we talked about the recovery of capital is with annuities in Section 72. Where you paid for the annuity, you give $1,000 to an annuity company, and they give you back $500 a year for 4 years. So was the first $1,000 of annuity payments return of your capital first, and the second part is your income the next 2 years, the last 2 years? Is it the first 2 years are income and the last 2 years are recovery capital, or something in between? And so we talked about the exclusion ratio under Section 72, which just tells you, say, what's your investment in the contract? In our case, it would have been $1,000. What's your expected return? In our case, $2,000. 1,000 divided by 2,000 is 50%, right? So our exclusion ratio would be 50% of each payment would be excludable from income. 50% of each payment would be includable in income. If you just keep in mind, if you have to do an exclusion ratio, it would be as simple as what I just described. But what that is it tells you how much is excluded from income, right? That's why we call it an exclusion ratio. The other side of the exclusion, if the question said, the prompt was what is included in income, it's the other part of the formula, right? In our case, it was 50-50, so it's probably a bad example. I can change it. Say it was $1,000 invested, $3,000 returned. And they were going to pay you $300 a month for 5 years. That's not right. That's $300 a month for 10 years. You would just say my investment in the contract's $1,000. My expected return is $3,000. my exclusion ratio is a third. So of the $300, $100 is excludable from income, $200 is includable as income. That's what the exclusion ratio tells you. It's to try to figure out that middle ground balance. And then we looked from there at the other side of recovery of capital, which is the recovery of loss. And we talked about like the Clark and the Burnett case. And we talked about that because that's the other side of, if I have to recover capital, how do I recover when I lose money? It's just the other side of the coin. And we talked about the problems. That was really the first time we talked about, it depends on who you're comparing people to as a baseline. But that's often the test we use in tax to try to figure out whether you have income depends on who we compare you to. And Clark was a good example of it. Clark said there was a non-deductible loss based on bad advice. And but the problem with Clark was, right, the court was comparing him to the person who had the recoverable accountant instead of the non-recoverable accountant. And depending on who you compared Clark to, you could come up with potentially different results. I think that's the lesson from Clark, as well as kind of the recovery of lost cases. Because we dealt with that also in the annual accounting context with Burnett. But what came of all these cases with the loss side was the loss rules changed, right? So a lot of the cases we dealt with were older cases that talked about the theory, trying to be the reciprocal theory of income when we talked about recovery of capital. Then the rules changed because the tax rules went from a situation where you had every year was closed after the year happened. So then we were going to worry letting years open and blend together. And once we switched the rules, we allowed a more smooth approach. And that's when we introduced Section 172, talking about carryover losses, right? The problem in some of these cases were if you didn't get the loss in the year it happened, you lost the loss altogether. You lost the ability to take the loss. So a lot of the early fighting was trying to get the loss in proper years. Once Section 172 was enacted, you didn't have to worry about that. And so Section 172 said, right, you carry it all the way back 10 years, right? If I remember right. I don't remember all this stuff off the top of my head. I think you carry it back all the way 10 years. So you go all the way back to year 10 is the first place you take the loss. And then you start to carry it forward year 9, year 8, year 7, year 6, year 5, year 4, all the way to present. And then you carry it forward 2 more years, right? I think it's back 10, forward 2. If I remember it right. Is it the other way around? Is it back 2, 4, 10? I just remember it's 10 and 2. Like, it's that, but the theory is the same. We went over it in class. There's a slide on it. It's very clear in it. But that's the key you have to remember is you have to go all the way back to the first year, and then you start wiping it out. That's the way it works. So that resolved the Burnett question. That actually resolves part of Clark's question, changing the way carryovers worked. It doesn't fix, though, the claim of right cases that are kind of similar to the claim of loss cases, which is the question which really introduced this idea of timing of when it's income, right? The claim of right cases, because I had income, but we weren't certain it was my income. I kind of had possession of it, but I'm not certain it's mine. And as you saw, no one's ever certain 100% anything is yours until you're dead. Like, the only certainty happens is when you're dead and no one else can make claims. So the problem you end up with we saw North American Oil and the Lewis case, we saw ways to approach the problem, but it really gave us a way to say when is income and when is it not income. Like, we know it's income, but there's uncertainty of that it's 100% mine, right? In those cases, there was litigation risk. And we talked about different ways to approach it. Section 1341 was the response to those cases that told you the kind of current approach. But understanding the two approaches to North American Oil and Lewis is kind of important as you think about just income and timing in general, which is understanding even though it's my money, and I'll talk about this briefly when we get to open transaction and constructive receipt and stuff, is even though it's your money, the question is it your money? And that's really that North American Oil and Lewis and stuff really should have been better later with Burnett. But that's kind of the idea of what's going on in those cases. So trying to figure out this contours of what's income, again, we looked at a couple other areas, which I'll go through. I'll try to hit them as quickly as I can, which were, well, what happens if I have income not because my money earned me money or not because I earned the money, but because somebody paid me for something they did wrong to me, right? Which is recovery for personal and business injuries. Like, that's another way you can earn money. And we talked about Section 104. So Section 104 for corporations become pretty easy for corporations. Damages for lost profits are taxable in the year they're received. Punitive damages are taxable in their year they're received. And the recovery of property or for property or destruction of property is taxable in the year it's received to the extent it exceeds basis, right? So if you think about the casualty loss as kind of a way to calculate it, it's kind of similar for corporations for recovery of someone hurts their property. For individuals, it's a little different. Settlements are tax-free to the extent that they're not punitive, that they're associated with personal injuries, right? We explored the settlements in context of 104 using like Dennis Rodman case as an example of, it's part personal injury, it's part punitive damages, but if you don't allocate, we're going to assume it's all punitive, basically. If you allocate, we're going to usually respect the allocation, and to the extent it's for personal injuries, those are going to be excluded. To the extent it's for punitive, that's income. We saw, though, even though it's for physical injuries, those physical injuries had to be, we talked about that in kind of the context of what counts as a physical injury. Does it have to be your physical injury, right? We went over that example where the husband saw the wife get hit by the driver. As long as the husband's injuries were on count of the wife's physical injuries, those counted as physical injuries for the husband, right? We explored the context and within of the contours of it within the context of that question of making sure we understood what the 104 requirements were. The other thing you have to remember about 104 is it's only not income to you to the extent you didn't deduct the medical expenses under Section 213. Right now we know 213 better, and I said in class at the time, it's doubtful that most people are taking the current 213 deduction for the medical expenses. So let's say you get hit by a car. It causes you $1,000 in physical injury expenses. You have two choices. You can deduct those physical injury expenses if you want to in the current year. You don't have to wait for the settlement to come in year 2 or year 3. You could deduct them currently. But in order to deduct them currently, you're under Section 213. And we learned, right, Section 213 is hard because first there's a floor, 7.5%. So you're only deductible to the extent that those deductions exceed 7.5% of your gross income, adjusted gross income. And those expenses may get phased out for other reasons under like the AMT. We didn't cover that, but they're subject to further phase out. So, and above and beyond that, you have to have been filing a Schedule A and not taking the standard deduction. So most people who are in that situation aren't taking Section 213 deductions because most people are just taking the standard deduction, so it doesn't apply, right? Most of us don't take medical expenses under Section 213. Very few people do. I mean, that's be a really expensive medical. You have to have a bunch of income, so you're not phased out, and you have to have a bunch of schedule. It has to be a bunch of expenses so that you can justify going over the 7.5% floor. But if you do happen to do that, then when you get the rest of the recovery under Section 104, that's income to you. So the 104 exclusion is for the people who didn't take it into income, didn't take the 213 deduction. Because if you've taken the deduction already, if you think about those claim of right cases, I've already taken the deduction against income. When I take the income, all I'm really doing is what? It's just putting myself back to the status quo, which is why this wasn't income to you in the first place. So that's, I mean, it's a nuance thing you have to know, but it's rare that it applies.
So you said we couldn't bring in like a blacks or something like that. Could we bring in the tax statutory supplement that was assigned on the textbook?
Yeah, you can bring anything I assigned on the syllabus. You can bring in. That's recommended reading, required reading. Anything on the syllabus you can bring in. So from then we went to loans and discharge of indebtedness income. So we said, okay, this should be income to me because I have more money now than I had a minute ago. Is it income to me? And we said, okay, loan proceeds aren't income because we expect you to repay those loan proceeds. That's like Crane and Tufts and everything, right? Loan proceeds aren't income. They should be income, but they're not because we expect you to repay them. If you fail to repay those funds, then we have a question of discharge of indebtedness income, of income. So the example that we started with is a really basic example. You borrow $50,000, you paid back $40,000. What's that $10,000? Should be income to you. You had an obligation to pay back $50,000, you only paid back $40,000, it's income. Is it always income? Well, it depends, right? Is it Zarin? Is the best way I can kind of approach it in a one-word answer. It is income to you if we had expectation that everybody had the expectation the loan was going to be repaid in full. If there was an expectation the loan wasn't going to be repaid in full, that's kind of Zarin, then it's not income. It's also not income if the reason you only paid back $40,000 was it was discharged in bankruptcy, right? The 108E. It should have been income, but it was discharged in bankruptcy under 108. So let me just make sure I'm clear on this. Our premise is it's not income when you receive a loan because we expect you to repay. If you fail to repay 100% of the loan, we have to say that should be income because our default was it should be income but for this exception. Now, is it income to you or not? And then you have to basically run it through an analysis of a couple different ways it's not income. The first exception to that rule is you're insolvent, and the reason it was reduced is because you had a bankruptcy adjudication on 108. It could also have been reduced because we did a purchase price adjustment, right? Which is the situation we both thought the car we thought the car was worth $5,000. I drove it. It was a lemon. It was really worth $4,000. I went to you. I said, either take this car back or I'm suing you under the lemon law. And they said, well, even as a lemon, it's worth $4,000. If we readjust the purchase price based on our mutual understanding of what the actual product I received was, that's purchase price adjustment, and that is not income, right? We renegotiated the deal. Not for any outside pressure other than the original deal was we both had bad facts on. It's also not income to you if it's reduced because there's like a statutory exception other than 108E, right, which was like the Jobs Act. If you have student loans, we expect they're not income to you because we expect you to repay them back. Your student loans get reduced because you go work at the county prosecutor's office for the government. And under the Jobs Act, your student loans get reduced every year you're working government services, right? That's like the subsidized way you get really bad salary, but you get a student loan reduction. That's not income to you. Or you have the Zarin example, which was the only way we instead of attacking it as the original debt was valid, and the original debt was agreed upon, and now we're readjusting the original debt, Zarin said, let's look at it essentially through a new lens, which is there was a problem with the original debt. So the assumption that the original debt was $50,000 was false. The original debt was 40, and if the original debt was 40, we don't have discharge of indebtedness income because even though the debt said 50, nobody thought it was really 50. Everybody thought it was really 40. And so that's what you end up with Zarin. But we also talked about the problematic approach with Zarin, which is Zarin's position was closely tied to the fact he had lost the money. Right? If you remember, Zarin was arguing that he had lost a bunch of money. He can't have discharge of indebtedness income because then he lost money and also had a big tax liability. It was problematic because had Zarin made those arguments, had he won, and the casino said to him, Mr. Zarin, we're not paying you, I was doubtful, as you all probably are too, that Zarin would have made those same arguments that the debt wasn't real and the casino didn't owe him money. So whenever you look at the Zarin type analysis, be just really cognizant of that the other side's going to argue, had you won money or had this benefited you instead of hurt you, would you be making the same argument? So if you're thinking about the IRS counter to a Zarin argument, the best IRS counter to the Zarin argument is Zarin certainly wouldn't be walking away from a windfall of money because he had won. And that's always the problem when you're talking about the Zarin type analysis. Is you're stuck with that. And then so then we looked at when you sell the property, now you have property subject to a loan, and you sell the property, what happens when you sell the property? And within that context, I said, you really kind of have to learn three things: depreciation and basis, debt and basis, and debt and sale proceeds. And so let me break those up in the three components. So the first one is debt and basis. Depreciation and basis. And now this probably makes more sense now than when we covered it, because we've covered depreciation. But depreciation basis is pretty easy, right? When I sell something, my amount realized is the price I sell it for, $100,000. If I paid $10,000 or if I paid $20,000 for this, normally our calculation would be amount realized 100, adjusted basis 20, gain realized 80. But we learned if I depreciated this property because it was used as business property, the effect of the depreciation is what? It's reducing my basis for the depreciation I took. So had I taken $10,000 of depreciation on it, my original basis was 20, I'd taken 10. When I sell it now, my formula is 100 minus my new adjusted basis is 10. My gain realized is 90. So depreciation and basis makes probably infinitely more sense now that you finished the class than maybe it did when we were talking about it. But that's how it relates together. If it's a business asset and you put it in use, you have to depreciate the asset.
So even if a person didn't elect to take it on their taxes, it's still reflecting on when they would sell?
If you, I don't want to talk. We can talk about that later. But that's a problematic accounting problem as opposed to like a tax problem. Depreciable property should be depreciated. Debt and basis is the question is, do I take this debt in account with my basis? And the answer is yes, right? And that was the Crane and Tufts case, which was the problem, which is, if I pay $5,000 in cash and I have $95,000 in borrowing, what's my basis in that property? It's $100,000, right? It's what I paid for it in my own cash plus what I borrowed, and that's what Crane and Tufts said. And it doesn't matter if that debt was recourse or non-recourse. And if I sell the property with the debt, what happens then? I have boot, right? Potentially. The debt that goes along with the property is boot, and we'll talk about boot in a minute. and if you go back and look at Crane and Tufts as cases, they both fall within a pretty easy paradigm of to remember this kind of situation, which is if you just look at the numbers on the face, especially like Tufts, all you're trying to do is just balance out the transaction as a whole consistent transaction, right? Which was, if you think about the IRS position in Tufts, was the basis was basically almost 1.5 million, which they calculated as the price plus the debt plus what they put down minus their depreciation. The taxpayer was arguing that they don't count the depreciation, and that's why the taxpayer lost. All the government was trying to do is put you back in the zero position, right? So if you think about these transactions as take the debt plus what you put down minus the depreciation, that should be your current basis in the property. And what Tufts tried to do is remove one of those components from the calculation, and that's why they lost. So, I mean, essentially what you have to remember is tax treatment should mirror the economic consequences. That's kind of the rule of thumb when you're doing depreciation. And then we talked about, after that, we went through a bunch of other stuff that were like cleanup income events, like illegal income. Do you have income from illegal events? And the answer is yes, unless you're Gilbert and you have court sympathy and you're not a normal embezzler, but 99% of the time, if you have illegal activity, it's income. When you get interest from state and local bonds, that should be income to you, but there's an exception to the income rule, right? It's kind of just within they could have put that earlier in the book if they wanted to, when we dealt with like other types of income. Sale of your home, is that income to you? Yes, it should be income, but section 121 tells you the exception to the rule, right? And that exception to the rule has to do with you get $250,000 per person, $500,000 for a married couple. You get it every 2 years, but it has to be your principal residence, or like I think a secondary residence that counts as a principal residence for some reason. I don't know the exact rule off the top of my head, but there's a specific rule that deals with that. And we talked about that in class. So that's the end of the income side. And then from the income side, we went to timing. And so we said, when is it income? And we broke it into income to two different questions: realization and recognition. Every transaction we've talked about in this class, there's an amount realized, right? Because our fundamental formula we try to calculate is, a gain realized is amount realized, which is basically what you receive, minus your adjusted basis equals your gain realized. Like literally every transaction you enter in your life has a gain realized. That doesn't matter to most people because you don't owe tax on realized gains. You only owe tax on recognized gains. So if you don't every transaction should have tax, should have a recognition unless you fall within one of the exceptions. So our default for timing is you have to recognize gain unless you can tell me a specific exception to recognition. And like we'll talk about it, section 1031 is a recognition exception rule. So we started the idea of talking about this with Eisner, which was the stock dividend case, if you remember it. And it was important because it talked about, here's a recognition event. And recognition events, the way to remember recognition events for tax, at least the way I do, is do you have a new bundle, like do you have a different bundle of rights in the property you have versus the property you had? And that ties through all this stuff. Like, do I have some new bundle of property rights, right? Because all taxes based on estate property rights. That's all taxes based on state property rights. So if you remember your basic property principles of I have a new bundle of property rights in this property, then that property, then I have a taxable event because I've changed my state property right bundle. And so that was the Eisner case. And so Eisner said, you used to have shares, you used to have 100 shares, now you have 200 shares. Do you have tax? And the answer was no, because you still have the same bundle of property rights, they were just represented differently. And then the consequence of it not being taxable, we had to worry about basis allocation then. So the second part of Eisner was, you had these new shares, but these new shares represented the same property right, therefore you had no income. But now I have to reallocate your basis equally amongst those new shares. That was the second part of the Eisner case. And you do that just based on fair market value. But what's good to remember about the case is Eisner would have turned out differently if you had different rights in the company, right? So if they split the stock into like voting, non-voting, Eisner comes out differently. Because now you have two classes of stock that represent two different property right interests. I actually would have income. We talked about Braun, about the constitutional argument being not good. We talked about the Woodsnam case. And the real case that we kind of highlighted with that was cottage savings, right? Where we were overlaying, there was two different administrative law agencies at work at the same time, right? You had the banking regulatory agency, the FHLB, and then you had the IRS, right, which is Treasury, which is a separate administrative agencies. And one administrative agency said the swapping of these mortgages of real property were a non-event for that agency's regulatory purposes. Was that agency determination binding on another agency, the IRS? And if you've had admin law, at least you can always, if you haven't, you'll remember this, right? One agency's determinations are not binding on the other agency. Especially, well, that's not true. That's true as long as you're within, they're governed under separate protocol, right? So that's mostly true. So IRS said, no, you have a realized loss. And so what did they test? They said, okay, do you have materially different rights with legal entitlements? And the answer was yes. You had different rights, different legal entitlements. For tax purposes, you had a different collateral, and that meant you had income. So even though another agency had a different reason, it wasn't binding on the IRS, and it then was allowing us to show, once we determined the agency rule wasn't binding, we were able then to explore whether you had different legal entitlements. And we spent a lot of time talking about how different or comparable it was to just the Eisner case, right? And it was pretty different. You had different property, different debtors, different collateral. That's pretty materially different than going from my equity being represented by 300 pieces of paper or 400 pieces of paper. Same share of the equitable pie. That's a pretty different situation than having different collateral, different debtor risk. All those things made it clear that cottage savings should be income. And then we talked about statutory non-recognition events. And so statutory non-recognition events, I mean, if it's not clear, we went through it in a lot of detail. We talked about 1031. We said, okay, here you have materially different rights in these two pieces of property. I should have income. And then we addressed it. We talked about it in terms of investment income. And then we added in the idea of, well, what if I trade this property for some stuff that's the like-kind property and some stuff that's not like-kind? And within that context, we talked about boot and basis. And I promised you that there would be like one of those on the test. We spent enough time going over how to do it. Everyone should be okay on how to do it. But if you can do it, the reason I make sure I test it is it shows that you understand the idea of non-recognition, but also shows me you understand when we talk about basis being manipulated and the effect of that manipulation, that you understand that basis is non-static at least. So that's an important thing you should be getting from tax. So from there we talked about we touched on some other stuff that we just briefly mentioned, like non-recognition in the context of corporate formation, non-recognition in the form of like constructive sales and mergers. But then we really picked up on a new substantive area with OID. Now, like I said, I'm not going to make you guys go through a complicated OID calculation, but you should be able to understand what OID is in its most general terms, right? Because generally OID is we don't believe your stated price because your stated price makes assumptions, and those assumptions include below market rates of return. And if you have something below market rate of return, it has to either be a gift or income. And since this is a business transaction, it's not a gift, it's income. And so we have to determine what it is. And what's the result of OID? It's just the result of doing the formula and everything we talked about in class is just a recharacterization of what you said the payments were to what they actually were. So in other words, what you've done is you've told me that you lent me $5 million and I was supposed to pay you back interest rate of 10%. So I was supposed to pay you back $50,000 a year. Well, the AFR rate was 15%. What I'm going to do is recharacterize your interest payment from 10% to 15%. So I'm increasing the amount of income I receive. That's what OID does. And it appears not only in loans, but it appears in below market rent. So if you're giving someone a deal on rent, you're like, ooh, I'm going to make you pay me $300 in rent when market rate's $1,000, so I only have to take $300 into income. That doesn't work. I need to take $1,000 into income, and we recharacterize the rent payments, even though I might not have received all the money, as $1,000 in income. So that's basically what OID does. And from there, we talked about the biggest timing issue that we have to worry about, which is timing of income really comes into the open and transaction, installment sales, constructive receipt kind of test. So once we're in the situation where we know this is income. The question we're really trying to sort out is when is it income? And so when we know it's income, we saw this in like Burnett, right? Which is Burnett said, it's income. It should be income this year. But the taxpayer is like, well, I'm not 100% sure it's income this year because it's a closed and open transaction. And the result of like the Burnett case and all the kind of subsequent cases that we talked about with when is it income is there's really three ways we can approach it when it's income. It could be that what we talked about kind of when we talked about Inja Land again, which is I paid money, I invested money to make money, I get my basis back first. That's an approach we see. We see the closed transaction approach, which was the government's position in Burnett, or we see kind of a hybrid approach, which is the installment method. Right? And we talked about the installment method, which is I'm a business, I invested money, I'm supposed to make money. When do I take the timing of that money into account? That was the Burnett question. There's really three valid approaches to that question. I wish I could tell you there's a great answer to the result, but it's basically, it depends. The only way we know it's installment method is if the taxpayer elects installment treatment. So if the taxpayer doesn't elect installment treatment, you're going to be basically in the Burnett quandary. So one way timing comes up is when we are investing money because we have to build the tollway, we have to build the toll bridge over on the other side of town. I have to invest money to do it. I'm basing it on the idea that I'm going to make money in the future. How do we take that money I make in the future into account? Do I get all my investment back first? That's kind of the Burnett position. Do I close the transaction in the first year of how much I'm supposed to make? And if I don't, then I take a loss, right? That's the government's position, kind of Burnett. Or do we do installment and take it over time? That's the taxpayer would have to elect that. The other way timing comes up is in the constructive receipt economic benefit context, which is really interesting now as you maybe look back to study it, because it really shows how we can learn a theory and then the tax law builds upon like a really core theory, right? So the core theory is I have income if one of two things happens. They both can happen, but as long as either or of them happen, we have income. Either one has to happen. One of them triggers income. It doesn't matter if you fail one and pass one. As long as you pass one, you have income. And those two tests were the constructive receipt and the economic benefit test. And constructive receipt, I mean, you can look at this in a like the amend case and all the cases we covered with it. The Pulsifer case, amend, all these different cases, which is constructive receipt is when I have a legal entitlement to come pick it up, right? We went through a lot of these and kind of the idea of like I wrote a check, and or you can come pick up the check when you can, right? Constructive receipt is if you can come get it, you have receipt of the money. The fact you don't, you're dilly-dallying along and not showing up till the next calendar year does not mean you don't have income. That's constructive receipt. The economic benefit test is, the question is, are funds set aside for your benefit? Right? So did I write the check? Did I put money in a blocked account? And if in either of those things happen, then I have income. And so once you learn those rules, then what I thought was interesting, you might not care about it, but what I thought was interesting, once you take these core concepts that we learned, you saw how they built upon it in a more sophisticated way by talking about like compensation, deferred compensation. So those core rules of timing that had to deal with constructive receipt and economic benefit then crafted a whole industry of people saying, I want to try to time when I know I have this income, but I want to try to time it when I want to take it into account. So how can I time it? Well, we talked about like non-qualified deferred compensation in the minor case. And what was that? A doctor was rich enough. They don't need any more income now. They want income in the future. Well, can I push all my income into the future? Sure, as long as I fail the constructive receipt and economic benefit test. So if I say, yeah, you work for me this year, but you're not allowed to show up to pick up your paycheck until 10 years from now, fail constructive receipt test. Yeah, I know you worked for me this year, but you can't pick up your paycheck for 10 years. And guess, when you show up, I'll give you money if we're still in business. I failed economic benefit test. So I'm able to change the timing of my income until the future. But the risk was I'm Enron. And you go to show up in 10 years to collect your money and you're not there to collect the money. I don't have any money to collect. And I have risk. So minor was this hybrid approach where how much can I hedge that risk and still fail both of those tests? And so minor worked because you couldn't pick it up until the future. It was set aside for your benefit, but it was still subject to the creditor claims of the general creditor claims of the corporation, right? So the trust account that I set aside your money for still was subject to the creditor claims of the corporation, which meant that it wasn't set aside only for your benefit. If it's only for your benefit, you lose. So you can see this little basic term was just a manipulation of this basic term for that. And then so we said, okay, that's non-qualified for deferred comp. Most people don't want to take that kind of risk in their life. That money's not set aside for your benefit, and you want to push a bunch of money to the future. That's for like rich doctors. That's not for the average Joe. So then you saw a response from Congress by creating what they called qualified compensation, deferred compensation. So in qualified deferred compensation, the money, you can't pick it up until the future, but it's only set aside for your benefit. And because it's qualified deferred compensation, we're not going to have the unfettered discretion we have in minor to put as much money aside as you want. We're going to have statutory rules. And those rules came in kind of two flavors, defined benefit and defined contribution. And so we will allow you to put aside money, but we're going to limit the amount of money we allow you to put aside for the future. And the reason the government conceded to doing this was basically this was a way that they could hedge their future obligations to us by having kind of a forced savings account, right? If they're going to have to pay you in Social Security, this is a way for them to subsidize their own future responsibility of Social Security by having you have a forced savings account. And we talked about the difference between a defined benefit and defined contribution plan. I'm not so sure that like you have to know more than just kind of the general parameters of what that is. But you can see how this basic rule we talked about has now kind of cascaded into its multiple forms. And then the last form of deferred comp we talked about that we spent a lot of time talking about was stock options. And stock options then allowed us to say, okay, this is something, this should be income to you. When is it income? And we talked about there's 3 different outcomes for when it's income. Income on sale, income on exercise, and income on receipt. And what you have to remember for that is the gain on sale is kind of the first rule you start with, which is those are called those are the incentive stock options, which are kind of statutory stock options under Section 422. So the default rule in stock options is actually, do you meet the statutory requirements under Section 422? So if you want it to be income on sale, you basically hit those statutory options, and that's where you end up. But most companies fail those options, those statutory requirements, and then you cascade into income on exercise. Now, you could end up in income on receipt if you meet one of 2 kind of requirements. One is the employee elects to treat it that way. That's the 83B election, right? It's the gambler's choice. You want it to be income today because you think this is going to have future appreciation. Or it ends up in there kind of as a B tract because the way the option had a readily ascertainable fair market value. It was non-transferable. It wasn't subject to forfeiture, right? So like if the option basically vested immediately in your possession, it should be income to you. Why? Because it's set aside for your benefit and you could pick it up immediately. You've basically failed those economic benefit constructive receipt tests. So it makes sense that it was income immediately on receipt, right? So if you want to see, not that it's maybe interesting to you, but that basic rule, then we built on that basic rule for timing of income to seeing how the rule could be manipulated in the context of changing the way your compensation is deferred. So from that point on, we moved to talking about other kind of timing issues, which is transfers pursuant to marriage and divorce. The rule now is basically 1041, which says it's most tax planning is out the door. If it's a property settlement, it's not income to either party, but you still have to meet the requirements of the statute, right? It has to be pursuant to a written divorce decree. It can't be you and I decide to split up our stuff and just orally agree to it, that doesn't count as a property settlement. We talked about it in context of alimony, which is the normal rules are payments are deductible to the payer spouse and income to the payee spouse in alimony. Because why? I mean, we talked about the policy reason for it, but it's not. But we have to be careful to say, is this alimony or not? Because we see things fail alimony all the time because it's not pursuant to, right? It has to meet alimony. We have to meet. It has to be paid in cash. It has to be under the instrument of divorce. You can't agree to have the property taxed as non-taxable. It has to end on the death of the spouse, right? We said all these requirements have to be in place for it to be alimony. Otherwise, it's not alimony. And if it's not alimony, it's not income to the recipient and not deductible to the payor. And we also talked about in alimony, I said you won't have to do the calculation, but you still need to be responsible for identifying it, which were the front-loaded alimony payment problem, right? Which you pushed a bunch of the classic example is the doctor and the law student, and the doctor agrees to pay a bunch of money while you're in law school, so they front-load the alimony payment for the first years you're in law school, and then after that it goes down because supposedly you'll be a lawyer making your own money, where you don't need the money as much, and that kind of a context, you have to be able to identify that that's a potential front-loaded alimony problem, and the result of that is that we're going to recast that alimony payment evenly over time as opposed to a bunch of current income and current deductions in those early years and fewer income and deductions in the later years. It's recast to be even, right? That's what you're responsible for. Understanding the premise, not doing the calculation, if that's fair. If it's not fair, I can make you do the calculation too, so you don't have to argue about fairness. I'm assuming that no one wants there. So that's alimony, and then we talked about child support, which is not income and not deductible. But we said, sometimes these things end up blending together, and we talked about that. And child support was only interesting in that you were able to learn a little bit about the way tax logic and tax policy work. If you go back through that and you understand now what we talked about, you should have a pretty good understanding about the rules for income and how those rules for income and debt and everything else we talked about interact with each other. It's probably worth a quick 5-minute going through those slides just to say, like, oh, I get this. And if you don't, ask the questions about it. I'm going to take a quick break here because I don't want to push my luck on this recording. And then we'll start up with deductions, and then we'll be done. Deductions go a little faster.